Sensex has delivered around 11% annualized return on an average for the last 4 decades. And this is despite the major drawdowns. And the drawdowns are very frequent, and on a day change basis, more than 45% of the times, it is negative return actually. So, is there any way where how we can reduce the downside during a drawdown and can be limited when compared with the index? And can it result in a superior return compared to the index as well? Well, the answer to this is having a right asset allocation. So let's look at the data where we look at the data for Sensex. So this is for both Sensex and the small cap. And so how do we read this table? Here for Sensex, we are having data from 1986, and for small cap, it is 2003. So, so this is the drawdown in the year 1996. So maybe an investor who has invested 1 year before this one, that is on 18th January 1995, his return would have been 19.4% annualized one. And he or she, if she has invested in 18th January 1994, the annualized return would have been 13.73%. If somebody has invested on 18th January 1986, her annualized return would have been 17.45%. Similarly, I have done the same calculation for the small cap funds as well. And I have assumed that this person has invested around 1 crore during that time. And all the reds indicate whenever they have fallen below the 1 crore. Right? For the year one and year two, there are like many reds here. So, and if you look at the total number of times the rates are there, in this case, I mean, like it is close to half the time. So during the drawdowns, it has always been that case. Now let's look at the asset allocation. With the asset allocation, can this be better? Right. So Sensex historic average has been around 11%. And current debt funds over the last several years have generated more than 7%. So conservatively, I'm assuming 7% is the return for the debt funds, and for the ease of calculation as well. And the conservative hybrid funds, usually they have around 70% in the debts, anywhere between 65 to 75%, and around 25 to 30% in the equity. So if we do the weighted average at 70% and 30%, this would be around 8.2%. So regarding the horizons, so anything less than 5 years should never be invested in the equities. And there is a high I mean, like if the horizon is over 5 years, the chances of negative returns are close to zero. That is like more than 98% of the times you make a positive return at least. And with respect to hybrids, this horizon has to be at least 3 years. And again, anything less than that, it should be going into the debt funds. See, while choosing the assets for the gold, equity has to be chosen for over 5 years. Right. So here for 5 years, I have taken less than 5 years, I have taken the debt funds only. For 7 years, it will be equity, and for 10 years, it will be equity. 3, 2, and 1, it will be debt funds. Now let's look at the portfolio, which is totally invested in Sensex irrespective of the time horizon. Right here, there are multiple times there were negative returns which were generated. This is from here. So if you look at the compounding, everything is what I have put here. Now let's see what happens with the asset allocations. Goals with less than 3 years, they are having in the debt funds. So, and for 3 to 5 years, it's in the hybrid. And for the seventh year, right? So 7 years is like that would be in the year of 1989. So from 1989 to 1994, it has to be in the equity. And from then on, from 1994 to 1996, these funds have to be moved into a index fund. So here what I have done is, so this is year D17 minus 2 indicates 1994, right? That's the value at which it is there. Till such point of time, what is the return which it has generated? So this is D17 minus 7, which shows year 1989. right? And after that, for the 2 years, I have compounded the liquid fund. So B3 shows that return here, right? Similarly, for year 10, so what I have done is like I have put in the equity funds for the 7 years, because 3 years is enough for the hybrid funds. Anything less than 3 years, it has to go into the debt funds, right? So this 1996 from 19 from this would be 1993, and then we are having it as 1986. From 1986 to 1983, it will be in the equity funds, and then for the 3 years, this will be compounding at a hybrid fund rate, right? So when we do this here, we when we do this for six, here we are having six different horizons and five different instances of massive drawdowns actually. So that is a total of 30 instances. In case of Sensex, the portfolio without asset allocation has performed only 2 times better than the portfolio with right asset allocation. And in case of small caps, so the outperformance has been around 6 times out of 30. So this is a proof that asset allocation drives the returns and protects the capital. So that is the case 90% of the time it has been true for the Sensex. And in case of small caps, that has been the case for more than 80%, like around 80% of the time. Now let's look at the returns of the portfolio with 100% equity investment in Sensex against the portfolio with asset allocation. So these are the annualized compounded CAGRs, actually compounded annualized growth rates here, basis the total investment in Sensex or else across the asset allocation. So in order to show the impact of this outperformance of portfolio with asset allocation, so we have looked at the median returns across different time horizons and the absolute outperformance over the median returns. So here, if you look at the median return in the year one, that has been 36, right? And in case of year two, that has been around 19.17%. So on and so forth. Same we have done for the small cap. So we have done something similar for the asset allocation, both for the Sensex and the small cap. Then what we have done is we have calculated the alpha. That is like on the median basis. Again, it's not a point-to-point basis, it's just the median basis. So compared to 36%, negative 36%, to the positive 7, the alpha is 43%. In the similar way, I have done it for the different time horizons. So what would this absolute return be? So in case of 1 year, it is pretty much straightforward, the same thing. So in case of 2 years, we have to compound it by 2 years. So that would be around 60%. In case of 10 years, this is a massive alpha, like 60% more absolute return, right? On the median basis, right? So the absolute performance is ranging anywhere between 8% to 83% in case of Sensex. And in case of small cap, that would be between 22 to 40%. To conclude, having a right asset allocation which is tailor-made for your goals can lead to a higher return generations, better downside protection, and can generate alpha over the index as well. So this video is for educational purpose only. It is neither a recommendation to buy nor sell the asset class in discussion.